Hello, hi guys. This is Samuel from PTN Analytics. From our previous videos, I informed you that the subsequent analysis that I'll be providing on this channel would be much more fun, much more technical, much more exciting. So I welcome you to an exciting edition of our analysis. This is purely trading education, which is brought to you free from PTN Analytics. And the topic for this education training is how Wyckoff analysis reviews smart money footprints. I believe at one point or the other in your trading career, you must have heard about Wyckoff analysis. And if you are new to Wyckoff analysis, I think this is a very good place to start to learn how to use Wyckoff analysis. I told you in the previous video that PTN Analytics utilizes the combination of Elliott wave analysis, Wyckoff analysis, and classical technical analysis in our analysis. So this is one part of our trading strategies, which will be unraveled in this channel. I encourage you, if you are new to this channel, to subscribe, to like and share this channel. This will be good for us as a trading education, and also would be good also for you and other traders to learn valuable content. All right. This video on Wyckoff theory provides traders and investors with insight into the strategies employed by large institutions or large institutional players, otherwise known as smart money, in the market. It suggests that by understanding and applying Wyckoff principles, individual traders or investor can gain a deeper understanding of market dynamics and potentially make more informed trading decisions, which is actually the goal of trading, to make informed decisions that would, result into profits. In this video, I will delve into the key concepts of Wyckoff theory, such as accumulation, distribution, springs, upthrust, and explain how they can be used to identify trends, reversals, and potential entry points. I'm going to also provide practical examples of how I applied Wyckoff analysis to real-world trading scenarios. So let's dive deep into the course proper, or the trading proper. This is the background on Wyckoff. Someone may ask, who is Wyckoff, or what is Wyckoff? Actually, Wyckoff is the name of a person. Wyckoff theory was developed by Richard D. Wyckoff. That is the man who developed this theory in the early 20th century. The theory is a comprehensive method for analyzing and trading the financial markets. You will understand as the training progresses. To understand it in historical contexts, I would like us to dive into the life of Wyckoff, what happened during his days in the early 20th century. Richard D. Wyckoff was an active trader during a time of financial markets, when it was evolving rapidly in the United States. The early 90s, that's the 90s, marked the emergence of modern stock markets, which is characterized by increased trading activities, the rise of financial journalism, and the establishment of stock exchanges in those days. So in those days, Richard D. Wyckoff was a stock market, trader was a stock trader. He was also a market analyst and an educator. He started his career as a stockbroker and later became the editor and publisher of Ticker magazine. He used to release weekly, monthly publication, in Ticker magazine, one of the earliest financial publication in those days. So his exposure to the markets and extensive analysis of price and volume, that's the data of price and volume, led him to develop the Wyckoff theory. There is one particular prerequisite that you need, to understand this knowledge. The data, the information you need is the information of price and volume. Once you are able to interpret price and volume, relationship between price and volume, then you are good to go with this, approach. Let's look at how Wyckoff developed this theory. Wyckoff, working, analyzing market data and studying the behavior of the market participants, laid the foundation for the Wyckoff theory. He believed that the actions of institutional traders and market makers left footprints on the price and volume charts that could be deciphered or gained or identified, to gain insight into the market trend and reversal. You need, a proper understanding of the relationship between price and volume to be able to effectively, apply this method. And then it will be more profitable for you when you are catching reversal or when you are catching the trend. All right. So this is the schematic, Wyckoff schematic data. This is for the accumulation phase. I'm going to explain what that means. This is preliminary support and then selling climax. We have automatic rally and then secondary tests. We have last point of support, another last point of support, then sign of strength in phase D, and then last point of support, and then the market moves up. Sometimes it is called markup. All right. So identifying these footprints of the market maker will help you to know, the phase in which you are. There are 5 phases in Wyckoff theory. The phase A, B, C, D, E. The E is the markup phase where the market moves in a trending, direction. So phase A has its unique characteristics which are different from that of phase B. Phase C also is peculiar and is different from phase A and B. So in this course, you would understand what happen, events that happens in phase A. What are the events, what are the attributes of phase A, phase B, phase C, and phase D, respectively. All right. So the core concept of Wyckoff analysis are the accumulation and the distribution. Those are the major core concepts: accumulation and distribution. Accumulation is a phase in which smart money is actively buying an asset. During accumulation, the institutional traders are, buying up assets, buying up financial assets. You know what I mean by an asset? All right, stock, currency, commodities. They believe that the asset price is undervalued or likely to appreciate in the future. That is why they buy. And the goal is to acquire significant position at lower prices before an uptrend begins. It makes sense to buy cheap. It makes sense to buy cheap, especially when you realize that a stock or an asset is currently undervalued. The value is so small. So institutional traders understand when the value of an asset is ridiculously low. And once that's that understanding is gotten, what they do is they quickly amass those assets. They gather them, keep buying, before the assets appreciate in value. So what are the attributes? How do you know when the market is accumulating, when institutional traders are accumulating a particular asset or currency pair? The attribute, what are the attributes of accumulation? During accumulation, price often moves within a trading range or consolidates. So this range here, this is what you have during accumulation. You realize that the market is trading in a range. It's not directional in movement. There is typically a series of higher highs and lower highs, indicating a balance between buyers and sellers. In this case, you could see that buyers and sellers are at equilibrium. There is that balance. Accumulation is marked by increasing volume as institutions accumulate shares, they accumulate assets, they accumulate the commodity. But this may not always be readily apparent to the public. It's not readily available, not readily apparent, visible to the public. So you need volume data to understand why is there a surge in volume without a corresponding surge in price. That is divergence. We'll get there. So what are the signs? How do you know? It is actually difficult to detect that you are in accumulation phase until you are in phase C, this phase C, because this could easily be a distribution phase also. But when you get to phase C or D, then it becomes clear to you as a retail trader. I'm talking from the perspective of a retail trader. How you can, position yourself in line with the institutional traders, the smart money, to take advantage of the imminent trending move. All right. So you can identify accumulation in phase C or D depending on your ability to recognize pattern. And then how do you know? You need spring, which is like a sharp price decline followed by a quick recovery. This is a spring. Spring occurs during phase C. It's like this is spring. It's a sharp move. There's a move here and there's a recovery from that, from that decline. This is like a trap. They call it trap, or it's also called stop hunt, because the participants here have been stop hunted here. All right. Then once you see this, then it's already giving you an indication that we might possibly be accumulating these assets. Then this is automatically followed by what is called sign of strength, which is like the occasional strong rally within the trading range. So this range, there's a strong rally within the trading range, and which indicates the presence of smart money buying. So this is when you can now position yourself to enter this trade. You can enter these three zones. Here, entering here may actually cause some damage. However, depending on the time frame, if you are trading from a large time frame, then you could also take advantage of the range movement. However, if you are trading on a smaller time frame, this area are the safest point of entry. All right. So I believe this is clear before I move to the next discussion. All right. So the next core concept is distribution. Distribution is a phase in which the smart money is actively selling an asset. It's like the opposite of accumulation. Distribution is the opposite of accumulation. Please take note. The institution believes that the asset's price is overvalued, that is, overbought, or likely to decline in the future. And the goal is to distribute their holding to the market at larger price. This is just logical. An asset that was initially worth $20 is now worth $100. At this point, you know that this asset is actually overvalued, because the real value of that asset is somewhere maybe here or here. And then, being an institutional trader, you know that that asset is actually not worth this amount. It's like an arbitrary increase, and there is a possibility of a fall. So institutional traders, distribute, they dump that asset at higher price so that they can make a lot of money. They sell when it is high, so that when the price of that asset drops, they don't lose what they've gained, over the period when the price appreciated in value. So that is just it. Distribution. So how do you identify distribution? During distribution, price often moves within a trading range, just like you also have it in accumulation. All right. And there is typically a series of lower highs and higher low, lower highs and lower lows, indicating a balance between both the buyers and the sellers. You can see within this range that there is actually a balance between the sellers and the buyers. There is a range. Distribution is marked by increasing volume, as institutions also distribute share prices, but this may also not be, visible to the public. So when you see surge in volume, like under here, you see surge in volume without corresponding increase in price, then you know that there is divergence between volume and price. All right? And that should call your attention to pay attention to activities, around that range or zone. Of course, what do you see during distribution? Number one is that there is always an upthrust action, which is like the occasional move above resistance. This is the resistance. And then there's a move out of that resistance. This is this, secondary test. However, the secondary test has created a resistance level. You can have multiple resistance levels depending on the nature of the charts that you are analyzing at that time. All right. So the market moves. There is that occasional surge out of that resistance zone, and then the market recovers back quickly. So this becomes the stop hunt or upthrust. So in another way, the retail traders call it stop hunt or liquidity grabs. But a Wyckofian, we call it upthrust action. Upthrust action. And then when it comes out, it quickly comes back in, indicating distribution and trapping bullish traders. So this is like a bull trap. The other one is a bear trap. And this is followed by what is called sign of strength. This sign of strength will now be followed by increased surge in volume. Here, this move may not be accompanied by surge in volume, and that will give rise to the divergence. So volume might be decreasing. In this case, you might have this volume here, the one here. So you have divergence, and then this one is rising. So you know that this move is actually what is called stop hunt or trap because of that divergence in volume. So this should prepare your mind for the move to the downside. When you get to the sign of weakness, which is sign of weakness, you now see a corresponding surge in volume, which is indicating a decline within the trading range and can signal the presence of institutional or smart money selling. So you position yourself to enter the trade when the market, comes back to the last point of supply. And then this is where you enter the trade. All right, before talking about entry strategies, I believe this is clear and it makes sense. This is how you identify, the footprint of institutional traders in the market. All right. I said that you need to have an understanding of price and volume, and which I have actually done an illustration in the previous slide. The synergy between price and volume analysis is at the core of this theory. And then traders, institutional traders, use both, to confirm their signals or their decision. Now, I've put down a sketch, like a chart, for us to have an understanding of how volume relates to price. A breakout, accompanied by a surge in volume is seen as a strong signal of a potential trend reversal, especially if it occurs early in the trading range, say in phase B. Okay. Now, you could see there is a trading range of my screen is not covering the entire chart, all right, but please bear with me. So here you see a surge in price. This bullish move to the upside was also accompanied by a surge in volume here. It was accompanied by a surge in volume here, this move, right? And then you see subsequently that the price, moves up while the volume comes down. There is no corresponding increase in volume. This is a sign of that. This is divergence, classical volume divergence. And what happened after this divergence was that there was consolidation. Price consolidated. This gave us an idea. This is a range. This is a trading range. And this is a classical sign of accumulation because you already have a divergence. And after this divergence, we go into a period of consolidation. So what do we have? We have what is called the buying climax, automatic rally, secondary tests. After the secondary tests, this has given us the first support level. Then we had the price move downwards. This becomes what is called in Wyckoff analysis, it is called the spring action. Spring action, like I said, we have upthrust and we have spring. This is spring action. All right, because if you trace it down, you see that it is not followed by a corresponding increase in volume. The volume went down. So this is a fake out. All right, because the market came, how do we know? The market came back immediately into the trading range and gave us another secondary test. After the secondary test, the market came back to that zone, nullifying, this spring action because it has been tested. So this becomes tests. And how do you know? There is still no surge because this is negative, that is the downtrend. You look at the down bearish volume data. It's not followed by a surge in price. So that is also like a test similar to this. Then after that, the market tried to move up. It couldn't break this minor resistance, and then it broke down the wall again. This becomes what is called the sign of strength, because out of all the volume data here, this was the highest, and then signaling interest of the composite operator, which is otherwise known as the institutional, traders. So this is giving us an example. This is giving us an alert that the market may go bearish. So we have this sign of strength. So what we need before we can take advantage of this position is we need the market to rally and get to the center, the middle of the trading range, and give us the last point of supply. The market came here and there was no rejection of that zone. So market went up again, couldn't break the resistance zone, and then we'll be waiting here. What happened here was that there was a huge gap, and that is what you need. You don't need a magician, a soothsayer, a prophet to tell you that the institution have actually caused this move. So the moment you see this move, you know that the institution are interested in going short. So what you do, you could enter somewhere here when the market opens, there's a gap. You come in here, we put your stop loss somewhere here, and you target 1 to 2, 1 to 3, and that is it. So this is a classical example of accumulation. I believe this is clear. All right, so divergence between price and volume, this is what we used, to determine the interest of the institution. A bullish price pattern. What is a bullish price pattern? A breakout from an accumulation range with increasing volume can provide a high confidence entry point. Look at this breakout. This was a very great breakout. This was a very great breakout, from that trading range. This also was a breakout, and that is actually what signals that the institution are interested in going short. Here, there was a sign, there was a surge in volume, but it was not followed by a corresponding breakout in price out of that strength range. So this is just not relevant. This is not relevant. But this becomes relevant even though it is not as tall as this, but it is compared to the other, bearish volume before preceding. This is actually significant, and that shows the interest of the market maker in going short. So I believe this is clear to you, especially if it occurs late in the trading range. So what you need this to look for this surge breakout of the trading out of the trading range in phase C or D or E. That is when it makes sense. Anything here in phase A, B, in fact C sometimes could be, a trap. So the safest is the D, phase D and E. You watch out for the breakout of price, which is accompanied by a surge in volume. That is your sure bet. All right. So let's talk about attributes of those phases so that we can understand the schematic, the Wyckoff schematic. Phase A. What do you have in phase A? I did not include preliminary support or preliminary supply. Why? Is because it's actually part of phase A, but it's not so significant. this is not so significant, this particular one, because it is not within the trading range. It's just to tell you that the trend was coming bearish, and prior to the climatic action, that is what you have. So that is why I did not include it here. All right. So the buying climax is the peak of an uptrend. In the case of an uptrend, you have preliminary support, then you have your buying climax, which is characterized also by increasing in volume activity. So you have a climatic action, and then it shows, the culmination of buying enthusiasm, and typically occurs just before, the reversal or correction. So you have this, and then you have automatic rally, and then you have your, secondary test, a test of this particular zone. So the opposite of this buying climax is selling climax, which you have here, selling climax. And it's also characterized by enthusiasm, selling enthusiasm, and then it's also like the peak in the opposite direction. Automatic rally is the next thing. It follows following the spring, or this is actually not supposed to be spring in this case. However, it also follows spring, but in this case it follows the climatic action, and it is characterized by a sharp rapid move to the upside in the case of a downtrend. But in the case of an uptrend, it goes to the upside. In this case, this is buying climax. These are buying climax. Then you have your climatic action. So this comes to the downside. In this case, this one goes to the upside. All right. And then the move signifies that buying interest has surged. In the case of, the downtrend, this is a surge in buying interest. In the case of a downtrend, it's a surge in selling interest, because this is the climatic action. You have your automatic rally. So this is like a surge in selling interest, depending on the direction. Then secondary test. This becomes a secondary test. This is like the testing of the support and resistance level during the climatic action. So the climatic action leaves behind the resistance level, which you draw like your range. And when the market comes back to that zone and is rejected off that zone, then this becomes a secondary test. It's very important. You need to master it. All right. So that is what we have here. In this case, it didn't touch the climatic zone area. It didn't touch the resistance, but it came down. So that is actually, you won't have a perfect condition or perfect situation, but with practice you should be able to identify the climate, all these phases, all these footprints. The second phase is characterized by selling secondary tests. This phase is not one, it could be two. Like I explained, you have your preliminary support, and then you have your selling climax, SC, and then the market reverses to the upside, giving us automatic rally, AR, which is characterized by increase in buying interest. Then you come back. Even though you didn't touch it, you have your secondary tests in the phase A. Tests could be more than two, in fact. So this has given us the range. This also gives us the range. And then the market moves and then comes back here. This is a secondary test again. This is a test. So after the automatic rally, there may be secondary test of this, of the support or resistance level during the climatic action. We could also have another test like this, secondary test again. See, So it could be more than one, it could be more than two, it could be more than three. In fact, the market may test this zone again. So, and that still is in phase B. So this is phase 1A, this is phase B, and then what happened in phase C? In phase C, then that is when you have the trap. So phase C, you could either have upthrust or spring, depending on, and you could have both in a trading range. An upthrust occur in phase C. An upthrust is when price, briefly move above resistance, but then quickly fall back into the trading range. Like I explained, this one, this is like this is exactly an upthrust. This is a trading range. It came in and then automatically came down quickly. It traps buyer and indicates that the selling pressure is lingering. All right, for spring, it is the opposite of upthrust. When you see a sudden or sharp breakout of the trading range and then the market quickly recovers back into the trading range, then this move is a fake out. They call it fake out or trap. You understand? And it's followed by a swift recovery back into the trading range. Spring plays a crucial role in Wyckoff analysis as it serves as an important signal of potential trend reversal. So people also take advantage of spring. They enter once there is that recovery or a test of that, and they enter here. But for this course, I won't advise you because it is assumed that probably you are new, or if you are experienced, of course, you could do that on a higher time frame, not on a lower time frame, because the move depending on the size of the trading range. So that is what determines how much you can make, trading spring. But I won't encourage you to trade the spring. Phase D is characterized by sign of weakness, which is like a sign of weakness or sign of strength. Sign of strength in the case of an uptrend, while sign of weakness in the case of a downtrend. It's like a notable bullish movement that breaks above, the resistance. But in this case, there is no recovery into the trading range. Of course, you could have, movement back to a particular level, but it will not come back deep into the trading range. And it suggests that increasing buying pressure and potential change of trend. That is actually what that means. That's what that means. Okay. Sign of strength also is the opposite of sign of weakness, in the sense that it's a bearish move, that fails to sustain above the resistance level. It fails to sustain above the resistance level. Okay, so this is what you have. You have a bearish move out of the resistance or support zone, and then comes back, and then you look for a reversal. So it signifies selling pressure also. You will understand this in a live chat or in when I'm showing you the practical examples. Then this is putting all together. Like I explained, the market was trending downwards. You have your preliminary support here. The market reverses from there and comes here. This is characterized by a surge in volume here. That's a selling climax. The market quickly recovers in automatic rally. Then, in order to test, this has given us the trading range. Then the market came back, to hit the support zone. Sometimes it may not touch it. If it doesn't touch it, then it's still in phase 1. If it touched it, then we are in phase 2. So the market came back and touched this resistance zone. It recovers. This is like a spring action, but take note, you cannot have spring action in phase 2. It has to be phase 3. And since this did not touch the support zone, it becomes ST. That's the secondary test. The market went up again and broke this level, right? Giving us another range. Like I said, we could have multiple resistance and support zone. But depending on how close, it is to selling climax. These are close. Then it's going to be either phase A or B. And you cannot have a spring action in phase B. It has to be phase C. So what you do is that you wait for the market to take out liquidity of this level. That is when you have your spring, and this could be taken advantage of. And then how do you know this is going to be like a change of character? You have a change of character here, the break of market structure. You could enter here if you are an experienced trader and you target the upper part of the trading range. If you are not an experienced trader, you wait for the market to break out of the trading range, giving you a sign of strength, and then you take it on the pullback to the last point of support in phase D. So for an experienced trader, you could trade phase C, phase D, and then phase E is too late because at then the market has already taken off. So you can only take C and D as safe entry point. Of course, for experienced trader, you could trade this range if there is enough room to the upside. But for the sake of this education, I encourage you to focus on phase C and D of the Wyckoff schematic. All right? I think I should erase this so that it can be clear to everyone. All right. Let's look at live example. Our previous analysis, on GBP JPY of last week was done using Wyckoff analytics. Wyckoff analysis. So we had a preliminary support here, and then the market break it with this candle. It is called sponsored candle. Sponsored candle when you have a long candle. These candles also are very important when you are identifying institutional footprints. You need to look for sponsored candles. Those are long candles. So this called our attention to the fact that institutions are interested in this range. So candle chart pattern analysis is also very important. When you want to learn Wyckoff analysis, you need to interpret the candle chart pattern. So like whether it is doji, engulfing pattern, railroad track, all this armor, you need to learn it. If you have not, been used to it, you need to learn it for the sake of this course, this training. All right. So we have a sponsored candle which shows the sign of institution, smart money. We have a climatic action here, and then relative to the candles here, it was the longest. This candle was the longest. So this before, because then this had not played out. So this was the longest candle, which is typical of the climatic action. All right. After that selling climax, we had a rally to the upside, giving us the first trading range. And immediately afterwards, we had a secondary test. So it shouldn't be a line, it should be a zone. Your resistance and support should be zone. Market came back to test that zone in, secondary test. You realize that I did not label this in phase A because there is a complete testing of the support zone. The market came and tested the support zone and then rallied up, broke the first layer came back, right, and broke it again. So in this case, we are expecting either spring or upthrust action. So what we had here was an upthrust action in phase C. Immediately after the upthrust action, in what is upthrust? Market breakout. And if you look at this, it is not accompanied by significant bullish, volume. If you look at it, that's the lowest. So this is like a fake out, So this is an upthrust action. Markets came back again. We have secondary testing of that zone. Like I said, we could have two. This is 1, 2, secondary test. The market rejected off that zone again and went back again and broke this resistance zone to the upside. In this case also, it is not accompanied by a significant move. Look at this candle. This is the candle actually that was responsible. If you compare it to this, you can see that this candle had a lot of move behind it than this. All right, so this is not an increase in volume because we had an increase here already. So what am I saying in essence is that this is also a trap. The market came back and then gave us a spring reaction. This also was a trap. After this trap, the market could not recover. And then we had this doji, right? Indecision candle. Market came back. These are signs of strength, or signs of weakness, rather, I beg your pardon. And the market came back again, tested this zone with another indecision candle. And then we had a sign of strength, which is accompanied by increase in volume. This volume is higher than this, you can see. So increase in volume, which is a sign of strength. So we know that right now, the institution have decided to go short. So what we do, we wait for it to recover up and then look for reversal pattern on higher or lower time frame or medium time frame. This is on 4 hour, and then we went to 1 hour and we saw a reversal pattern here, and then you enter here, and this has given us more than 3 RR. The market is still going to go down. The market is still going to go down because after a distribution phase, we should have significant downward move. This is just first part of the move. We still need to see more move to the downside. So this is the summary of how to, identify institutional footprint using Wyckoff analysis. I hope this is clear to you, and then if you have any question, you can drop it on the comment section below. I think I also have another example that's. Thank you very much. Let me share with you one more example on my trading view. It's a real life analysis that I did, and I think that would help you. All right, let's get to this is my analysis. This was done on August 1st, and then I shared, this is buying climax automatic rally tests. We had like a spring reaction, upthrust. We had a sign of strength, sign of weakness, then the markets. And what happened eventually was that we caught this move. And because we knew that the market still had more room to the downside, we predicted that the market was going to come down. I won't be able to go deep into what we look behind the scene, but this is on a 15-minute time frame. All right, so let's see what happened, how the market actually played out. my internet is not strong, but you could look this up on my trading view. This gave us, I think, let me show you how this was done. The target closed, and then our targets, the target first and second targets were hit on the same day. So if you check my analysis, that's on TradingView, you'll see it. My internet connectivity is poor. Sorry about that, but I'm gonna make it up to you in the subsequent lesson. Thank you very much for staying with us. Bye for now.